Today, we'll be talking about real-world assets, RWAs, with Chris, co-founder of Plume.
We build tools and software to help turn the real world into things that we can use on-chain. RWAs, if you want them to grow on-chain, they have to look and feel like crypto because you're serving a crypto audience. That's what people tend to forget. Then you have to create utility and make sure it's composable, usable, all those kinds of things. We combine software, tooling, and ecosystem to make this a coherent environment to actually grow and bring these things on-chain.
Isn't regulation an issue here?
When people want it, they'll find a way to make it happen. This idea that we need to be super regulated, it's just not true. It means you built a product that nobody wants and you blame regulation for why no one wants it.
The Uber example.
Uber was illegal for many years. A lot of people used it. They went to Washington, they changed the law. If you're a big asset manager and you have trillions of dollars of your clients' money, you're not going to gamble in crypto to try and earn them a little bit extra yield. But what I think we have to understand is how do we cross these two bridges?
Hey, Sohejl here. Thanks for tuning in. Real quick before we begin, if you enjoyed this episode, if you learned something, please consider to follow or subscribe or share this episode. That helps us out a lot. It helps us to reach more people and to spread quality education across the space about crypto and Web3. Also, if you're part of a crypto project or represent one and you would like to come on the show or do sponsoring, please get in touch with us. And lastly, everything we talk about today is for educational purposes and no financial advice. Enjoy the show. All right. Thank you for tuning into another episode of the TEACHMEDEFI podcast. Today, we'll be talking about real-world assets, RWAs, with Chris, co-founder of Plume. Hey, mate.
Hey, what's going on, man? How you doing? Thanks for having me.
I'm good. How are you? How's life?
Good. It's been busy, but it's been busy and terrifying. The market's up and down. Things are crazy, but overall, I think all positive. I think things are going in the right direction, and especially for RWAs and tokenized stuff, we can get into, of course. But I think a lot of the stuff happening in the world has been very positive for us. So good.
Awesome. It sounds good. And I've seen you guys have a lot of traction. You're working on a lot of things. So I assume it's an exciting time. Yeah, I mean, to kick it off, speaking of interesting times, I guess, we had obviously Larry Fink saying something to the tune of asset tokenization is the next generation for markets and a revolution in financial ownership, I believe. So obviously this is something you guys are working on. So what is tokenization in your own words, and why do you think tokenization is so meaningful?
It's been a crazy time, with the recent administration, and really it's not even before that, with the BTC ETF. That's kind of where this all started, right? After the spot BTC DF passed, within, I think, a day or two, Larry Fink was on stage and on CNBC talking about tokenized assets and talking about, the ability to tokenize everything and be able to put things on chain. And it's been a huge catalyst for a bunch of the things that's been happening, right? We've seen not only they've brought BIDL on, right, which is their tokenized money market fund. For them to make a move here, so many other different entities, different institutions, different governments all around the world are all trying to think about tokenizing assets, right? Now, I think it's been very positive and a very good thing, and I think overall is a step in the right direction, right? Now, I think the one thing to stay mindful of, though, and I think the thing that people tend to forget when it comes to stuff is at the end of the day, where does the volume come from? Where does usage come from? I think people see things like BlackRock, right, coming in, and they say, oh, the tokenized or institutional capital is here. I see these tweets all the time. Institutional money is here, right? And it's always funny to me to see because I think it's, despite being an industry that lives in a blockchain where everything is public and open, people never check the block explorer, right? Because if you go to these things and take a look very quickly at the assets here, you realize, so RWA.xyz is kind of sort of like the DeFi llama for RWAs, and so to speak, right? All the stats so you can kind of see what's going on. You can see very quickly, right? There is zero institutional dollars coming in. Right, there's institutional assets coming on chain, right, but no institutional dollars, and so that to me is like where things are going right now. Which is like what we're really doing here is we're bringing a lot of institutional demand on chain. Excuse me, a lot of institutional supply on chain, but the demand is still light. It's still new, right? And look, it makes sense. These folks are trying to find AUM. They're trying to find new ways to grow the size of their funds and everything, and so it leads to a lot of catalysts and things that are happening here. But I think we do need to temper and understand kind of where things are. This is a long-term, durable secular trend that is going to be very good for all of us. We just have to understand where we are so we don't lead to a path of disappointment or lead to a path where we're sort of expecting X and getting Y, right? Ultimately, what we want to do with all this is grow crypto. That's what this is all for, right? The things that are exciting to us that way. But if we look at where we are today, we are not growing in crypto, right? At the end of the day, what we're doing is actually shrinking the pie. We're bringing new assets in, which is great, but the size of the pool has not changed. Crypto is still a $3 trillion asset class. It has not grown by any significant means since then. And so, it's more people competing for the same dollars at this point. Right. And so we need to find other ways to complement and then think about that. And so it is positive right, and a step in the right direction, but still a long way to go, right? But it couldn't be better for tokenization, couldn't be better for crypto, couldn't be better for where we are today. But I think it's good just to temper and sort of get a reality check on kind of where we are, because I think a lot of people, especially the reporters, love to kind of run away with the story and think that it's all happening today and the money's coming in, right? But it takes time, right? And just sort of thinking about it logically for even 2 seconds, it's very clear that if you're a big asset manager, right, and you have trillions of dollars of your clients' money, right, you're not going to gamble in crypto to try and earn them a little bit extra yield. Right? Risk is a number one component to them. What you're going to do and what you're open to do is, why don't we take my products and see if I can sell more of it? That's what they're doing today, right? They're not gambling they're or spending or even speculating on that money yet. And so things are not coming in that way, but a lot of new assets are. And that's exciting on its own, right? I think that's a very, very positive thing that allows the sort of audience today to change what they're doing and have more tools to interact with, right? So I think the story around RWAs has been misunderstood for a lot of things, but it's been very positive, right? Like we're working with different large institutions all around the world, and different governments and all these kinds of things. And so lots happening here. But overall, I think a really exciting time for everything that's coming.
When you say there's more supply there, because I've seen that as well, looking at some blockchain explorers and tools. Is it what you mean that there's a lot of supply, for example, minted? Like there is stablecoin being minted on the chain, but it's not like been distributed to other wallets. It's not in use on chain.
Both of these things, right? Exactly. So look, both mint, but also just like the quantity of assets, right? So BlackRock's got Biddle, you've got Franklin Templeton's fund, we've got bunch of things, right, that are coming on chain, right? But the volumes are not huge yet, and they're small and they kind of top out very quickly, right? And if you look at the money, it's still on chain demand, right? It's not crypto, it's not off chain demand yet, right? And so that's what I mean by supply. Lots of people are trying to put things on the blockchain. Not many new people are buying them yet.
Okay. So what's needed to make that happen? Is there a demand that's sitting sort of on the sidelines? For example, is the user experience too bad? Are the applications not developed so that people can, get some utility out of these things? Or what's the issue?
Yep. I think it's two things for what it's worth. And look, I think this is all very exciting stuff still, right? The fact that any big institution wants to come in and do stuff in crypto is great news, right? But what I think we have to understand is, how do we cross these two bridges, right? How do we put this thing together, right? At the end of the day, if we pull that thread, which is people are trying to come into crypto today to distribute their products, right? The question is, if you think about product market fit as a frame for this type of thing, you've got a product, you've got a market, you've got to put these two things together. We tend to forget the market side of things. Most RWAs today and these tokenized funds are trad people doing trad things, right? And so they end up building a trad product. It just happens to live on the blockchain, right? And so if you look at any of these products today, the question I have from 99%, has anyone used these things? Have you used them? Have I used them? And the question is no, almost unanimously, right? And if you go to RWAs XYZ, it'll tell you the truth. It's about 50 buyers for these things. It's all the same people, right? It's the Polygon folks out of 10 different wallets. It's the Aptos folks out of 10 wallets. It's foundations. That's it, right? And there's only so many of them, and they're really just doing. They're not continuously buying either. It's one big purchase that sits there to do nothing, right? Because they're just looking for the story. They're not actually trying to think about using these assets.
Yeah, I was just gonna say that it's basically the news article, right? That says,
yes, that's exactly right.
The meme of institutions are coming, and
That's
then you
exactly
have
right.
the news. You're like, here, it's not a meme anymore, and no one.
and then you move on, right?
Yeah.
Exactly. And people just forget about these things, right? And so if you look at these things again, we'll go buy a headline, 20 million bucks. And look, it's a real product. So I'll get 5% on yield on it. It's okay. We're still making some money, right? And then we'll move on from it afterwards, right? Now, what does it actually mean? Look, if people actually tried to use these products, they would give up in a heartbeat, right? Because most of these things are a pain in the ass to use, right? It's KYC, KY beat up, right? It's usually QP, means qualified purchaser, means you need 5 million liquid in a wallet to do this, right? And you need to go through it like a several week KYC KYB process. I've done this many times, right? Pain in the ass, right? Then at that point, usually there's a bunch of like restrictions, right? Meaning it's $1 million minimums often, right? And maybe once a quarter you can withdraw 100K max, right? And things like that. That's not universal, but across the board, that tends to be like how things look, right? So if you think about that versus your average crypto product, the user experience is horrible, right? Like, is so many steps in between. And the market, when you put $1 million limit on it and a $5 million liquid limit on it, right, you shrink the market by 99%, right? And so that's really like the problem with these assets today, is the user experience is no good, right? And it's not just the user experience from a usability perspective. The second piece, what do you do with it after? Sure, buying the thing is cool, right? But what assets really pick up volume and velocity, right? It's the ones that are composable in crypto, the ones that you can actually use elsewhere. What actually has real long-term stable buyers, has utility, meaning I can take out loans, I can lend and borrow against, so I can put this into a perp stacks and gamble on it and use use it as collateral to take out a position, right? That's kind of what this is. If you look at any great asset in crypto, that's what happens. And actually, if you look at one of the greatest assets in crypto, one of the greatest products in crypto today, right? It's an RWA. It's a stablecoin, right? And the stablecoin is both arguably one of the best products in general from a business model perspective, from a product market fit perspective, but also from an onboarding perspective, right? All the like net new users are either meme coins or stables, right? Meme coins are great in their own right. Stables a different audience, but they're both great tools, right? And so if you look at that today, I think the stablecoin gives us the path and shows us the go-to-market path to how to bring these assets on chain, right? Stablecoin was built for crypto, right? The stablecoin doesn't feel like a normal dollar, right? The normal dollar, I got to go to a bank, I got to sign up a bank account, I got to do all this nonsense, and then I can finally get a dollar, right? Or I got to get a job and sign this whole thing up and deposit. It's like a whole thing, right? In crypto, I can go to any pool right now, swap into it. Now I hold this. Now I hold the USDC or USDT, right? That's how these things work.
Or you might not even be able to get dollars on your bank in your country.
100%, exactly. And a lot of places have no access, right? Whereas in crypto, you can go to any pool, swap into this thing. Now I'm holding the dollar, right? And so that's the distinction here. Whereas, like, the stablecoin tells us the path. These RWAs, if you want them to grow on chain, right, they have to look and feel like crypto, right? Because you're serving a crypto audience. That's what people tend to forget, right? And the reason why people forget about this stuff is because stablecoins have just escaped the RWA category, right? Because they work, right? The stablecoin itself, right? Even the naming, right? A stablecoin as a name is a descriptive name. It tells you what it is. It's a stablecoin versus an RWA, real world assets. It's a categorical name. It just is a category of things. You have all kinds of shit in there. We have cars, we got watches, you got financial instruments, you got private equity funds, you got your solar panels, you got everything. It doesn't make any sense. There's no category in the world where all those things are in one, right? And so as these things gain traction, it's almost definitionally mean it doesn't work yet, because as they gain volume and velocity, they have a descriptive name that comes out, right? The stablecoin, tokenized equities, right? Maybe now you're talking about T-bills, right? As they have usage, they fall out of that. So almost definitionally speaking, when you say RWAs, it means it doesn't work yet.
It's kind of like the meaning comes through the use. So once you figure out what is going to be used for what purpose, and then people start giving it the descriptive name. And
That's exactly right. That's exactly right. And so it's really those two things, in my opinion. It's, I think, one, an orientation, meaning you have to know who you're trying to work with, who you're trying to sell to, who's trying to use a product, and then building a machine that makes that actually happen, right? And so that's what we do today at Plume, right? We've got this ecosystem, right? It's a couple things, but we have a bunch of tools that turn the real world into tokens. That, to me, is what we're doing here, right? And that's how we grow these assets, right? These things ultimately, just like the stablecoin, should look and feel like crypto, right? When RWAs are done right, they're not RWAs anymore. They're just crypto, just like the stablecoin, right? No one even thinks about stablecoin as RWAs. They just describe it in crypto, right? And so that's the starting point, I think, right? And then from there, right, then you have to create utility and make sure it's composable, usable, all those kinds of things. And so that's what we do today, where we combine software, tooling, and ecosystem to make this a coherent environment to actually grow and bring these things on chain, right? And so that's, to me, like where things are going and how to think about all this stuff.
yeah, interesting. So one point that you mentioned, I wanted to talk about more, which was you said it is not easy to use what we got at the moment, like with RWAs, and there's know your customer rules and things like that. But I was wondering, isn't regulation an issue here? Like, there's all these regulations with what sort of what sort of assets, who can hold them, what you can do with them, where you can trade them, this and that. And then if you bring it on chain and those regulations still hold, doesn't it make it automatically a worse user experience that's also like less composable than with other things, just by the nature of the regulation it needs to comply with?
I think there's two comments about that, and I think you're totally right. Right, most RWAs, in my opinion, most assets, when you put them on chain, become worse versions of themselves. Right, like take the T-bill. The T-bill on chain sucks. Right, the off-chain T-bill is way better. Right, the off-chain T-bill is safer. Right, and costs less money. Right, on chain you have to now pay two people, right, to hold this thing. Right, and you have more fees, and you're taking smart contract risk. Right, and so of course there's risk here. Right, and so this product is definitionally worse. Right. And like you said, for most of these things, they're not composable, right? It just doesn't. So you buy it, you can't do shit with it. It sucks, right? So the way I think about this, at least, is yes, regulation is a thing that matters. And I think it opens up the doors for a lot of stuff, right? Regulation is also one of those things that is an excuse by most people, right? Regulation follows behavior. Uber was illegal for many, many years, right? It turns out people want to like get cars and push buttons and get cars, right? And then the rules changed, right? They're meant to protect people. They're meant to do a good job, right? And they're meant to sort of help people do the right things versus get scammed by shillers and hucksters, right? And so that to me is like where things go. Regulation is a thing, right? But you have to think about it from a user perspective because the regulation and what does it sit in the stack of things that matter? That's number one. Number two, again, looking at if you look at things today, right? People tend to forget, but these things are already here. They already happen, right? Meaning DAI as a simple, or USDS right now, right? You've been able to buy treasuries permissionlessly through DAI forever, right? This is not a new thing. This happened for 2 years now, right? They've done such a good job, nobody even knows, right? And so that's the distinction, right? There are many ways to do this already that happen, that exist in front of us, right? People just tend to forget or don't want to think about it, right? And you just have to get creative, right? Because again, people that are coming to this think about this, that what they're trying to do is replicate the real world on chain. That's what most people are trying to do in RWAs, right? And build a carbon copy of what's happening already and just use crypto as a backend, right? As a way to automate a bunch of infrastructure, right? So this way, fund automation, fund distribution, fund management, fundraising, all those things are more automated, right? In my opinion, it's the wrong way to look at things. Doesn't mean those things are not benefits. They are, right? But in my opinion, it's missing the point of putting things on chain and what you can do with it, right? When you take that view as an example, you're trying to, again, replicate things that are already here and automate things that people can't see, right? What ends up happening is maybe the fees are a little bit less because now the fund admin is cheaper or whatever. So things happen. But like the product is ultimately the same, right? Versus take USDS again, right? Like, there's a very stark difference in both adoption and volume for something like USDS or DAI, right? Versus something like, take a Centrifuge's product or Ondo's product or whatever. And you can just look, right, at the usage for that kind of asset, right? Versus something like USDS and DAI, right? USDS and DAI has billions of dollars in volume, hundreds of thousands of holders, right? 500,000 holders, and the TVL is way higher versus the other products, right? 50 holders, no volume, right? TVL's okay, it's growing, right? But it looks very, very inorganic. And it looks very forced, right? Versus the natural usage that happens, right? So you can tell, right? There are rules today. So anyone that says regulation is a thing, right, tends to just sort of not understand that people, there are ways around it, right? They may not be perfect. They might be more expensive, might be a pain in the ass, right? But it's a very clear model in front of us today, right? Even if we look at just stablecoins proper, right? Stablecoins have always been a bit of regulatory issue, right? People talk about regulation is always funny. The number one stablecoin, the number one RWA in the world, we have no idea what's under the hood. Tether, we don't even know what's there, and everything's fine, right? Not to say it's good or bad, but just to say this idea that we need to be super regulated, it's just not true. It's just not. It means no one wants it. That's what it really is. It means you built a product that nobody wants, and you blame regulation for why no one wants it, right? When people want it, they'll find a way to make it happen. It's already shown itself in Tether, in USDS, and all of these things.
Okay. I think this is exactly what I wanted to talk about next, based on what you just said. The Uber example. So Uber came up, was and changed regulation essentially in a lot of countries, right? Now, why was that? I would say it was more useful to people, the way it was. So it kind of like naturally shifted the market towards the direction, and regulation changed. Is that something you're also like kind of referring in crypto to, in terms of, yeah, for example, the stablecoin issuers that are currently just, they just issued them on chain and it's in one wallet or 50 wallets of the foundation and nothing is being done with it. So they will see, plus, let's say, yeah, I guess those companies will see the demands that could be there if they could make this more widely usable and composable and all that. Perhaps they look over to MakerDAO. Was it?
Yes,
USDS? Was it USDS?
that's right.
I keep forgetting the acronyms. So they see the difference, and then they go, okay, if we change things also in terms of regulation, this could open up a big markets and a lot of revenue, a win-win, so to say. Is that a way that this could play out? Or
I think it's possible. I still think it misses the point, right? And it's sort of, in my opinion, perhaps an underutilization of what could be done, right? What is inherent in that view is saying, look, the market today is mostly other people that want to do things, and the reason why they don't do it is because there's no way to get access to these things, right? That's what they're trying to say, and it's just not true, right? Again, like, stablecoins. If you want stablecoins, you're going to get stablecoins today, right? There are no. That's why, and I think the stablecoin example is a perfect example of the Uber example, right? Which is like Uber was illegal for many years, right? They went, and then a lot of people used it. They went to Washington, they changed the law, right? That's just the U.S. too, right? The world is in general is fine, right? If you look at stablecoins again, what's happening right now in Congress and in DC, right? They're trying to pass the Stable Act, the Genius Act, right? These things are trying to get these laws passed because everyone wants to use them, right? And around the world, right? In Brazil and Latin America, right? In Southeast Asia and all these places, stablecoins already become a thing, right? There is no question, right? And so to me, it's one of those things, same things again. Sure, if we pass regulation, do things grow more? Probably, right? But it grows more to people that are gated by these things. It just, again, goes to the fact, like, I think let me put it this way. I think the stablecoin is going to grow whether or not these things pass, right? Like, whether or not the stable of the Genius Act passes, the stable coins continue to grow. It will continue getting adoption. It will continue to be a thing, no matter what, right? And I think the sort of the slope of the curve may change here and there, right? But I don't think it dramatically differs, and that's what I mean. I think when people blame regulation or people like overly focus on it, right, they're missing the point, right? Users will find a way to it if they want it, right? Nobody wants KYC tokenized T-bills. That's like the reality, right? And so a couple foundations, sure, right, but that's a limited market, right? Versus the actual end user in crypto, right? That to me is where things are, and you can follow the behaviors and see it, right? So does that make sense?
Yeah, that makes sense. And I think, speaking of stablecoin growth, I think we can show this graphic now as well, which is last year's stablecoin volume apparently exceeded Visa's volume. And I think it looked like pretty much doubling within a year.
Which is insane for that size and that volume.
It is quite striking. But yeah, tell me then a bit more about like what you guys are doing at Plume to kind of bring RWA to more people and push this whole thing forward.
The main thing that we do and we focus on, it starts with the philosophy, which is that crypto natives are the way to go. That's how you build it. If you want to build RWAs, if you want to build in the crypto market, you got to build for the crypto market. That's the number one insight, right, that we have, right? And that's different than everybody else. Everyone's waiting for someone else to come, right?
Mhm.
So we focus on what's already here, which means we build tools and software and things like that to help turn the real world into things that we can use on chain, right? And so it's about making things permissionless, it's about making things open, right? And it's building a big ecosystem and making things go. We have over 200 projects building on us today, right? These assets are, again, we don't control things in the sense that we're open permissionless ecosystem, right? So you can build whatever you want. If you want to build a permissioned and gated asset, you're welcome to that. We're not going to stop you, right? So not everything is permissionless on Plume, but what we focus our energies is helping turn things into permissionless versions of themselves, and then making that composable across the ecosystem. And so you can then go to our lending markets on Mystic or Solera or Morpho or whatever, take out loans against this thing and loop against it in a way that you do with anything else that's already known. You can do that now with RWAs on Plume, right? You can then take that same asset, put that into one of our perps decks, whether it's on WooFi, on Orderly, whether it's Satori, whether it's this, right? You can use as collateral and open a position. Now you can do perps, right, on other things, right? And then we can continue to expand the base of assets, right? So you go from things like T-bills and collateralized data, CLOs and corporate bonds and sovereign debt and private credit and these types of things. Now you do equities. Now you can do things like tokenized gold. You can do all kinds of things. So the idea is to expand the assets by a dramatic amount, right? And then expand the venues in which those assets are supported by a dramatic amount. So when they come on chain, they actually change, right? Going back to the comment before, right? Most people are just trying to carbon copy the real world and put it on chain, but the product is fundamentally the exact same thing, right? For us, the distinction is, I think when you put things on chain, they actually, the nature of it changes, right? The product changes itself.
It's like putting newspapers on the internet back in the day.
Exactly, right? You can put newspaper, you can like, we still have the New York Times, right? But where do people actually get the news? It's Twitter, right? It's Facebook, or I guess some people do, or whatever, or TikTok, right? The format changes, right? When you change a new sort of like paradigm in technology, right? The new thing is still solving the same problem, right? But the format changes and the thing differs a lot, right? And actually, if you go, I think it's a great example you said, because I always use this example. Right? If you go to Uber again, right? If you look at the iPhone, right? You can check. I can go to my bank account on my phone today, right? I can read the news today on my phone. But what really made the phone become so special and popular at the time, and what really drove the adoption, were things like Uber, things like Airbnb, right? Things that took advantage of the native architecture of the phone, things that you could not do on the web, right? On the phone, you have things like location, you have push notifications, you have a simple scrollability, right? You have big buttons, and you have payments integrated, right? All of these things made Uber something you could not do on the desktop. And that's what people wanted to go do and grab the phone for. And Airbnb was the same thing, all these different things. And it changed the dynamic of how you use these things. And then, of course, all the other stuff that you could carbon copy then came over, right? So you do both. But that's not what drives the change, right? It's never, oh, I'd just rather do the exact same thing here. Nobody gives a shit. It's got to be a new thing. And so that's why I think it's important to bring these assets on chain. It has to change, and it has to fundamentally be different than what it was before. Otherwise, who's going to care? Just like you said, who's going to buy tokenized T-bills on chain? I can just buy them and fit my brokerage account right now. It's a better experience. It's faster. It's cheaper. It's safer, right? So I'm only going to come to crypto to do things I can't do today, right? And so what is that today? It's meme coins. I can gamble on shitters, right? Or if you're in a different country, you cannot get American dollars and US dollars, you can buy that, you can hold stables, right? And so how do you bring those two things, both things, but it's one access comment, number one, right? And when you talk about access and then talk about KYC, those are two antonyms, right? And those are opposites, and so that's why it doesn't work. So number one, it's an access comment. And number two, it's a format and usage comment, right? Which is, once you put it on chain, what can you do with it, right? Can you then do what you can do, stake and loan and lend and borrow, right? Can you actually change the nature of these things, right? And because when you turn the real world into tokens, the beautiful thing about tokens as a format is the token is extensible. You can do anything with it, right? You can cut these things into a million pieces. You can change them up. You can put them in real, you do whatever you want, right? So take something simple in the real world. Take something like private credit, right? Everyone's been talking private credit recently. I've always thought, last year it was funny, nobody cared about private credit, but today people do, right? So private credit today, right, is a duration based thing. So I have to hold this asset for 6 months, right, and or however long, right, and I'll get some yield, usually a higher yield than something else, right? But there's risk involved, right? Because if I'm holding it the longer I'm holding it, who knows, right? And so in crypto tends to like risk free, tends to like permissionless, or we like hyper risk, but still permissionless. So it's still liquid, right? And so if you look at something like a token now that represents private credit, what you can do now is take that same asset and break it into a million pieces, right? And create a bunch of tokens against it, right? And each one is programmatically designed to do something different, which is saying, okay, instead of waiting 6 months, you can now redeem this token in 1 month, right? But the yield is no longer 30%, it's 20, it's 5%, right? But you're still getting a better yield. Still pretty good, right? Or that means also now the 6-month tone, which is if you're willing to hold this over an entire 6 months, all the yield and the risk you're taking adds up. So now you can get 50% APY on this thing, right? And so now you're allowed to sort of mix and match and customize the profile for this thing for the individual, right? And so if you're bullish on the asset, you're going to get way better yield than before. If you are like somewhat bullish, but you don't want to hold that long, you go take a haircut, right, on the yield, but you can get out faster, right?
So can you give an example for private credit? Is it, for example, like a receivable that you buy?
Totally, yeah, exactly. Like a receivable. So exactly. So let's just say, as a simple example, I'm in the, I'm like a textile shop in Southeast Asia, right? I make clothing, right? And to do that, I need money. It's an expensive thing, right? So ultimately, I turn money into threads. I turn threads and humans into clothing, and I sell that and I make money, right? When I get that money, I then go to pay back my vendors, right? But in order to get the initial piece, you got to get the factory, the people, the threads, all this kind of stuff is expensive, right? So what people do, they do what's called private credit. It's a small bit, and this is an example of it, right? But you do financing, invoice receivables, right? So when you're an established business and you have a flow of this, right? Now I can go out to lenders and say, hey, look, like you can look at my history, you can see that this is a thing. I'm able to sell these on a very regular basis. I've got money coming in, but time is a thing, which means for me to have all this money tied up in all these things, waiting 3-6 months for me to actually go through the whole process and sell this thing is difficult for me. So I'm willing to sell you these receivables now, which means I can sell you my future cash flow for money today, and you'll get a yield on it. Now, usually it's a pretty favorable yield, and usually it's fairly low risk, but who knows? Maybe the factory blows up, right? Maybe it goes to zero. Who knows? But because of that, they're willing to do pretty good because, again, there's risk in money. There's risk in time, right? So the longer that you have to be without it, it's dangerous. So if you're running a big factory on tight margins, having a huge bunch of money like floating out to your suppliers and to distribution people, it's just tough to handle, right? So having a bit more cushion, you're willing to spend to do that. That's what this example is. And so you could usually go to a bank and say, hey, look, like I'm willing to sell you this receivable, which means in 6 months when the customers pay me, right, and I'm able to sell these clothes, I'll pay you back, and actually I'll give you a pretty good return because you're taking on this risk, right? And so that's usually the thing. But now a couple of things that are inherent to that. One, it's hard to diligence, right? Because who knows? At the end of the day, what you're talking about is like, is this clothing shop going to make it? Right? Like, are they still going to be here? So that's number one. Number two is then actually accessing the money for those folks on the other side, which is like today, there's only so many banks that are willing to do the work to figure this out, right? And so your sort of pool of capital is limited, you know. And so for them, they have a very difficult time. And many of these things, there's many bad ones, but there's many good businesses that are trying to access the money in different ways. And every dollar they can get that they can raise is really beneficial for them, right? Because they can now really increase the rate of return on cost of dollars. Because if you just have, again, if you have $1 million or $100 million tied up in distribution, in operations, in vendors for 6 months, it's just harder to run your business versus having a cushion is worth the money.
High working capital.
Exactly. That's exactly right. Right. And so if you can now distribute that to other people and allow people to get the return directly, you cut out the middleman for this type of stuff while still providing the infrastructure to make sure it's safe. Audits, reliability, all that kind of stuff, right? To make sure it's fundamentally, and you can underwrite this asset. But now if you can pass those yields back, those yields are always much higher, right, than something like a 5% T-bill, right? So you can get higher yields. And so if you can pass that out to individual users in crypto, you can finance these businesses, right? And you can actually make a much better flow of money, right? So that's what this idea is and this example is, right? So, but when you look at this as a vendor, right, I don't want to deal with 10,000 people in selling these like $5 increments, right? I don't have time for that. I go to one place. I need to just look, I need $100 million right now. I'm willing to pay you a 20% APY on this, right? I have historical precedents. You can look at my history. You can look at what's going on. You can decide whether you want to do it, but I'll give you 20% APY on this thing, right? And you'll get the money in 6 months. But that's how these things go. But now you got to wait 6 months, right? And so that's the example of today. There's a limited amount of people who want to do that. Now, if you can break this thing up and create more dynamicism around this, it's not just a secondary market. You can change the nature of the loan, right? Sure, there's an initial period where we got to get the money. But after that, you can change the parameters and customize things, right? So sure, instead of a static 6-month loan to 20% APY, right? Now we can do, 1,000 tiny loans that build up with all different durations, all different yields, right? And really increase the rate of what we're doing here, right? So it's not just purely secondaries. That's what everyone always talks about, right? Now you can raise this money, right? And now if you want to get out early, there's a secondary market for it. Those things are always fanciful. It doesn't make any sense either, right? Because it implies a secondary market to exist. We've seen this already. NFTs are a perfect example. There's no liquidity for a lot of these things, right? So just assuming a secondary market comes out of nowhere is bullshit, right? The secondary market has to be built over time with demand and with utility, right? And so that's what this stuff happens. That's why maybe you can change the nature of the deal. It's not just you can now buy and sell it faster, right? You can change the product itself to serve different users, to serve different markets, right? Not a lot of people, right, that I know today at least, are willing to hold an asset for 6 months with 20% APY. That's just a long time, right? But now if you talk about, look, I can get 10% on 2 months, maybe, and maybe I'm willing to take that risk, right? And then maybe on the other side, maybe I can take a little bit of insurance policy against it. In case it goes up, I'll pay 2% insurance. So if it goes to shit, I get, I get my money back. But now if it doesn't go, I lose a little bit. I get 8% yield, but still pretty solid. That's better than 5% on T-bills. I could do a lot of size and that increase my. So now let me say you can change the nature, right? So now you're going from 6 months, 20% static to a customized profile for that user, right? And not only do you change the product, you can now put other things around it, like insurance, right, to increase your yields. It's classic that Pendle did yield stripping, right, which is an example of taking one product and really being able to increase the yields against it, right? It's the same thing that's happening here, but across any kind of asset.
Okay, that's interesting. Yeah, you're right. I haven't really heard. I think this is a product component that you mentioned there, which is like a selling point. Then, like with the different timelines, then the 6 months. Because usually when I've heard people talk about this, this is also called PayFi, or like as a vertical. I think is invoice financing.
The PayFi is a subset of this, right? PayFi really is a very specific type of invoice financing, right? Which really is what they're doing is it's a lot of FX risk, right? When you want to transfer money between different countries, right? It's just like a liquidity pool today. It's just like a bridge, really, right? A bridge, you need money on both sides, right? And it's expensive to do that because you're holding money sitting there doing nothing, right? And there's risk in between, right? When you move money from US dollars to the Great British Pound or euros or whatever, right? there's FX risk that you make, especially with size, right? If you lose a few bips here and there, it can be costly, right? And so stables are instant, so you can make this thing much more efficient, right? And take away the risk. And so that's what this PayFi is. It's financing these things. And sure, on the other side, a lot of times it is small business loans because you are paying another vendor, right? It's a very specific, narrow thing, but it is a thing for sure. And that's another good example.
Yeah, I think on the small business loans, I've heard that, okay, it opens you up to a global market, then bringing that on chain and a bigger pool of financing for like these small businesses that might not be able to get the financing through traditional terms. But that is again more in terms of like this, there'll be a secondary market type thing. But you mentioned concrete like product components that are are able to be created once you bring this on chain, which I think is more of an interesting selling point.
Yes, that's right. That's right. Exactly. So yeah, that's the story. I think it's really about just making sure these products can be usable for people. And what do people want in crypto? They want yield, right? So how do you create interesting yield opportunities that are actually safe and straightforward, right?
Right. What's Robinhood 2.0?
So the story for us is very simple. I think it's our articulation of what we are trying to do and how our view differs from others. Now, the problem with that metaphor, for what it's worth, is that Robinhood's American, right? And so a lot of folks don't know what Robinhood is, right? But I'll give you an example, right? A lot of people, when they talk about RWAs, they really think about, a new coming of Wall Street, right? Or new coming of international finance. And they think about big banks and institutions and all these kinds of things, right? Things that are very out of touch with the average person, right? With regular people, right? Now, the other side, and it's more of a business and B2B type thing. The other side of things is the retail side and the bottoms up side of things. And I think that what we're looking at is a historical example. Robinhood, right, is a mobile trading app, right? So you can now buy and trade equities on your phone, right, in a mobile optimized format. It's a great UX, and most importantly, the thing that they brought to market in the beginning was that it's free, right? There were no commissions on trading, so you could buy and trade equities with no issues, right? They found other ways to make money, right? And because they changed the UX and the format and the audience, they were targeting a different group of people than before. It wasn't someone who was a power user sitting from the machine looking at 15 charts. It was the average user, right, in class or at school or at, trading in between and break at work, right, on the phone, right. Because there was no fees, because it was mobile only, and the UX changed and the product changed, right. It really optimized towards tons of volume, right, and tons of transactions on very small dollars, right, and a different audience, and it grew people who were interacting with equities, right. And that was Robinhood was, right? And the best example of how that's changed, right, I think, is when you look at something like Wall Street Bets and GME and AMC, right? There was a period of time in COVID, right? If we don't remember, there's a GameStop was the equity that like went absolutely nuclear, right? GameStop, went nuts. AMC followed Doge and SHIB and all of that. And that was kind of the birth of meme coins, right? Which is like, it doesn't matter. The fundamentals don't matter. It's about the vibes. It's about people do like this asset or not, right? And Robinhood was a big enabler of that, right? And because the nature of the asset changed, because it was a new format, right? And also a new audience, right? It allowed a new group of people to actually grow that market, right? And then actually show how the growth has actually influenced the market. Meme coins are a thing now. Number two, at that moment, GME, AMC itself was a thing. It actually bankrupted Melvin Capital. Melvin Capital was a big institution, was a big hedge fund trying to short this, while basically the Wall Street community, a bunch of random people on the internet, drove it up. And what they did was they bankrupted an $8 billion hedge fund, right? So I think it's just a good moment in time to kind of signify that the retail user, right, and the consumer, when you change the form of the product and the audience, you allow them to come together in an organized fashion, actually is more powerful, right, or just as powerful as the traditional financial institution, right? And so versus our view is versus replicating that, which is what most RWAs are, right? Is we are focused on the latter. Let's allow the retail audience and the group and the people to come together, right, to use these things. Let's change the nature of these. Let's focus on a different audience. That's what this Robinhood 2.0 story is about, right? We today focus on ecosystem. We focus on community. We focus on international audience, right? We focus on everybody. We focus on crypto, right, and the crypto native audience versus trying to bring trad people in. They will come. I'm a very strong believer of that, but I think the starting point is there, and that's how we think about it. And that's what this Robinhood 2.0 idea is about.
Interesting. Tell me more about this, because you said it a few times now, and I resonate with it, which is change the format, which I think also implies a bit when you have this disruptive innovation, you often have like a change of format around how these things are solving problems. So what is kind of like the change of format? Can you give some more like tangible ideas around apps, perhaps the app layer or things to do on Plume?
Totally. I think it's very simple for what it's worth, but basically there's two ways to do it. One is you take an existing asset and you change how you can access it, right? So instead of having to do all the things we just mentioned for T-bills, right? $100,000 minimums, $1 million minimums, $5 million KYC, blah, blah, blah. We should build a bunch of infrastructure that takes that same thing and puts it into a format that you and I know and use every day, right? The swap box, to, from, swap. That's it, right? There's nothing to think about. Just like the way stablecoin is, I just swap into any pool, right? That is one way of changing the format of things, right? The way of accessing it has just changed on its own, right? So that's number one. Putting everything into that idea, so I can swap in anything anytime and it's composable and usable. That on its own is very different than what it was before, right? People would say that for Robinhood equities, right, making it mobile first and free, right, isn't a huge change. It turns out it was a huge change, right, because it was served a different audience. This is the same thing, right? By fitting into UX that this new audience likes, we've changed it, right? That's number one. Number two, you can also then look at a more fundamental level, which is like when you think about RWAs, people tend to think that there's something sitting in the real world and you've created a receipt token against it that then lives across crypto. So there's something that's backing it, right? We think much more broadly, right? Which is the word, the phrase RWAs, in my opinion, means interacting with the real world. It's not just about this asset or whatever, right? And when you interact with the world, there's many ways that you can do that, right? For example, right? I always think there are two sides of the same coin. One is you look at like equities again, right? If you wanted to bet on AI today, right? If you want to bet on AI today, right, what would you do, right? Likely the best way is to buy NVIDIA, right? And that's the way to express that idea, right? But it's a very messy thing. NVIDIA has so much baked into it. It's a big company, right? The PE, maybe it's overbought or maybe it's too popular. They do a lot of other things. You got to think about hardware risk and supply chain risk and all kinds of stuff, right? But you're just trying to bet on AI, right? It's a very messy way to bet on AI, but it's a decent way today, right? If you want to bet on, and so that's like what the world is today. Things are done through proxies, right? If you wanted to, if you look at WorldCoin, right? WorldCoin's price and the price action tracks exactly to Sam Altman's life, right? Sam Altman's career, right?
Really?
Sam Altman, yes, exactly, right. When Sam Altman gets fired, WorldCoin dumps, right, from OpenAI. When Sam Altman gets rehired,
did that happen when you had the period? Yeah.
Yes.
Okay.
Yeah. If you go look at the chart, you can tell when Sam Altman gets fired, price dumps. When Sam Altman gets rehired, pumps again. Sora 2.0, the new model comes out, price pumps again. Right. WorldCoin is a proxy, not for the goal. It's not about this orb. It's a proxy for Sam Altman because Sam Altman is one of the founders of WorldCoin, and he's very popular because of OpenAI. As one of the founders of OpenAI too, right? And so, like, again, people are trying to speculate on that. And now take it completely the other side. Take meme coins, right? All the meme coins today are based on like real world things. Trump, Bowden back in the day, right? Even the Malay token, whatever the hell it was called, right? Libra, I guess, right? All these things are like ways to identify and speculate on the real world, right? Every new popular meme, like Ashton Hall with the ice water and the banana stuff, right? After that, you had routine, right? You had all these. Every sort of popular meme has some tie to the real world as well, right? So I'm not saying we need to tokenize and like do all that.
Everything's real world assets in a way.
Yes, that's how I view it, right? That's right. Yeah. And so how do you actually do that today? How can you create, again, the focus is to me creating net new things, right? A net new thing, as a simple example, right, is the ability to look at something like a country, right? So, if you were to just use a data to pull this together, right, instead of having to if you want to bet on AI, right, if I could just take an index of all the AI companies, right, and their popularity and put it into a chart, people would rather trade. That's a more direct way of doing things, right? And so there are ways to do it. So, for example, one of our protocols, you could take out a 50x lev long on Pokemon cards, right? You don't have to tokenize every card in the world to do that. You can just bring out the data feed of the cards, and now I can speculate on the card price without having to actually buy these cards or ever having to tokenize these cards, right? You can build a derivatives, a synthetics market on top of these things, right? And if you take that analogy further, which is just you're using data now to rely on things, you can use a bunch of different data feeds and combine them in interesting ways to create better and new representation. So instead of having to buy NVIDIA to bet on AI, you can get a direct index of AI, which is, maybe I'll look at like, GPU compute, maybe I'll look at like how many parameters each model has, and I can speculate on that, right? And there are more direct ways to influence. So you could take something like, for example, one of our products called Cultured, right? You can now, bet on America and like short China, right? And what is America? It's a collection of like 50 different data feeds, right? You take GDP, CPI, you take population growth, you take all these things and you weight them in different ways, right? Now you have a single thing, right? And again, talking about changing the format and putting it into a chart, it goes into the thing that we all familiar with, which is the 1 second chart, right, in crypto, right? That's what everyone wants. Up, down, left, right? So how do we take the real world and fit it into that? That's what we're doing here. And that's a net new thing. Now it's something you can't do in the real world. There is no way to speculate directly on this. If I wanted to have, if I were bullish on Sabrina Carpenter back in the day, right? Or I was just like, I watched White Lotus. I knew that the Lisa, was going to get super popular, right? How would I have bet on that? It's not possible today, right? But this way I could. Right, I take a feed that's mentions of Lisa. I take Blackpink listens, or on Spotify. I can pull the API for that. Right, you take mentions on Twitter for this kind of stuff. All the content she's created, it's clearly gone way up. Right, and so that's another way. There's no way to speculate on that today. So that's what we want to do.
Yeah, to be fair, shout out to Polymarket as well. It showed that there's a big market around these things, eh?
Correct. That's right.
Yeah.
I think Polymarket's done a great job of bringing this to life. I think the downside of Polymarket is it's yes no. Right, you have to have a position, and it's time based.
Yeah,
right, it's hard to do. Right, people are not used to that format. Right, people are used to a very simple format: yes, no, up, down. I think, given where I think things are today, Elon will be more popular tomorrow than today. Or Trump will be more. That's what people think about. So I think there's still some work to do around that. But overall, yeah, they've shown that there's tremendous demand. People want to express their ideas in different ways, and the tools are not here yet.
Right. Quick gear change. What's the worst thing in crypto? And what do you hate most? What's the worst thing in crypto now?
I think the there is an interesting point in crypto where you have the old guard that wanted to be a certain thing that maybe feel let down, and you have the new people that are very bullish, optimistic, and maybe making a lot of mistakes too, right, and doing a lot of the same stuff before, right. But the combination of that is very bad right now. Right, in the sense that you have just a very negative sentiment. It's very nihilistic.
A lot of infighting, is it?
Exactly. There's a lot of infighting. It's a very pessimistic view of where things are going. Right. That's what's happening in crypto, and that's what I don't like about what's going on here. Right. I think it's true. It's messy. Things have not gone the way we thought it would. And but overall, we're still better than we ever thought this would be. Right. Overall, it's still very positive. Overall, right, we're still growing, right, and there's no better place to be, And so, I think that's the benefit. But people tend to get caught up in the day to day. It's all going to zero. It's a bunch of scams. It's this and this. Everything's scams. The internet today is 99% scams. We always the same 10 websites. That's how it goes. So I think people forget that, and so because of where things are, because of price action, because of how things are, because of expectations, it's led to a pretty negative cycle. And so that's why I'm not a huge fan of. But but otherwise, I'm still very positive on everything.
Fair enough. I mean, yeah, you're building in the space, so you must have some optimistic lookout on it. So can you tell us a bit just about the timeline around Plume, and if someone wants to get involved now, how can they, and what's coming next, and when is the launch, and what is it? Is it a chain, a layer 2? I think I saw it's maybe built with Arbitrum Orbit, but yeah, tell me about it.
That's right. Yeah. So Plume, it's a chain. It's going to come out in the next few weeks. We'll have more to come there. So feel free to come and take a look, and follow us on Twitter and all that kind of stuff, just to get the latest announcements and everything like that. So we'll have more that gets released there shortly. It's ultimately just a chain. And the infrastructure doesn't matter, right? At the end of the day, you bridge in, you deal with, interact with it, right? We're much more flexible. For example, our token today is tradable on Solana, right? So despite us being a gas token and a network chain and all those kinds of things, right? A network token, excuse me, that you don't have to just bridge over to use it, right? We want to make sure that RWAs, again, our focus, our intention is to grow crypto. We want to make it easy for everyone to interact and deal with crypto and real-world assets, everyone, and grow this market. And so we work with everybody out there to make it happen. So, if you want to come and interact and deal with Plume and stuff like that, please bridge in, do your thing. If you don't want to, there's many ways to get exposure other ways as well. But that's the idea. We're going to have this ecosystem. We're excited to bring a lot of these products to market. And we think that it's going to take time, for people to understand and think about how to use these things. The story around RWAs is very convoluted today, and people don't understand. The story hasn't been told very well, but we can fix it. We can make things a lot better. And so that's kind of the focus for us and our intention.
Awesome. Chris, lovely chat. Thank you for coming on the show. We'll put those links in the show notes as well. And I'm curious to see how RWAs, where they are headed and what role Plume will play.
Awesome. Thanks for taking the time. I appreciate it. Thanks for having us, and appreciate getting to chat. We'll catch up again soon.